Listen closely, trader. There's a number on your chart right now bouncing between 0 and 100 that 97% of traders are reading completely wrong. They see it flash 70 and they sell. They see it flash 30 and they buy, and they lose again and again and again and again. But what if I told you that this very same indicator, the relative strength index, built fortunes for the men who knew its true secret? What if the three strategies I'm about to share with you today are the same hidden patterns that separate the consistent winners from the desperate gamblers in this game? Stay with me for the next 35 minutes, because what you're about to learn could very well change the way you read a market for the rest of your trading life. But before we dive into the meat of today's lesson, I want you to do something for me. Look down in the description of this video. You'll see two resources I've prepared specifically for traders who are serious about transforming their results. The first is my ebook, Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. This isn't a get-rich-quick pamphlet. This is the distilled wisdom of a lifetime spent in the pits, the bucket shops, and the boardrooms of Wall Street. It's the mindset that turned $5 into $100 million during the crash of 1929. The second is the Livermore Journal, a 90-day trading psychology workbook. Because here's the truth, my friend, knowing strategies is only half the battle. The other half? It's between your ears. This workbook will rewire your trading psychology in 90 days, page by page, trade by trade. Both links are waiting for you in the description below. Grab them now, because you'll want them by your side as we go through today's strategies. Now let's talk about RSI. Pull up a chair, trader. Let me tell you a story. Back in my day, we didn't have computers. We didn't have flashing green and red bars dancing across a screen. We had ticker tape, chalkboards, and the most powerful tool any speculator ever owned: our own observation. We watched price. We watched volume. We watched human behavior repeat itself, hour after hour, year after year. And the men who understood that behavior, they prospered. The men who didn't, they fed the market. Now, fast forward to your modern age. You have an indicator called the Relative Strength Index. It was developed by a fellow named J. Wells Wilder in 1978, a mechanical engineer turned trader. He created this indicator to measure something very specific: the speed and the change of price movements, the momentum, if you will, of a stock or a currency or a commodity. The RSI runs on a scale from 0 to 100. And from the very beginning, traders were taught two simple rules. When the RSI crosses above 70, the asset is overbought and you should sell. When the RSI crosses below 30, the asset is oversold and you should buy. Simple, isn't it? Too simple. And that, my friend, is precisely why 97% of retail traders lose money using this indicator. Because they treat it like a magic 8-ball. They shake the chart, they wait for a signal, and they take it without thought, without context, without confluence. Let me explain something to you that I learned in my 40 years of speculating. Markets are not mechanical. They are emotional. They are driven by fear and by greed, by hope and by despair. And no single indicator, no matter how mathematically elegant, can capture the full picture of human behavior on its own. When you see RSI reading 70, what does it actually mean? It means the recent upward price movement has been strong relative to the recent downward price movement over a defined period, usually 14 sessions. That's it. It doesn't mean the price is going to reverse. It doesn't mean the trend is exhausted. It doesn't mean you should sell. In fact, here's a secret most traders never learn in a strong trending market. The RSI can stay above 70 for weeks, sometimes months. I've seen great bull moves where the RSI was pinned above 80 for the entire ride. The trader who shorted at 70 was wiped out. The trader who held the long position to 90 made a fortune. This is the first illusion you must shatter. RSI is not a reversal indicator. It is a momentum indicator. And momentum, in a strong trend, is your friend, not your enemy. Let me give you a real-world example. Imagine a stock breaking out of a long base. Volume is expanding, institutions are accumulating, the price begins to rip higher. Within a week, the RSI hits 70. The amateur trader sees this and shorts. Why? Because his textbook told him to. Within 3 days, the stock is up another 15%. The RSI is now at 85. The amateur gets stopped out. Or worse, he averages down. By the time the stock finally cools off, he's down 40% on his account. Meanwhile, the professional trader, the one who understands what RSI actually measures, that trader is riding the move. He recognizes that an RSI of 70 in a strong uptrend is not a sell signal. It's a confirmation of trend strength. He's not looking for reversals. He's looking for continuation patterns, pullbacks, consolidations within the trend, opportunities to add to his winning position. Do you see the difference? It's not the indicator that's wrong, it's the interpretation. Now here's another secret. The standard 14-period setting for RSI is not sacred. It's simply what Wilder chose because it worked reasonably well across multiple markets and timeframes back in 1978. But markets have changed. Liquidity has changed. Volatility profiles have changed. Many of the most consistent traders I've studied today use different RSI periods depending on their style. Scalpers may use a 9-period RSI for faster signals. Swing traders might use a 21-period RSI to filter out noise. Position traders might combine multiple RSI periods on the same chart to gauge momentum across different time frames. There's no single correct setting. There's only the setting that fits your strategy, your time frame, and your psychology. The second great illusion of RSI is that it works in isolation. Let me be clear with you, no indicator works in isolation. None. Not RSI, not MACD, not Bollinger Bands. Not the moving averages I'm sure you've memorized by now. Indicators are tools. They are not strategies. A hammer doesn't build a house. A carpenter does. And a carpenter uses many tools in concert to build something of value. In the same way, you must learn to use RSI in concert with price action, with volume, with market structure, and with the broader context of the market environment. Is the overall market in a bull phase or a bear phase? What is the sector doing? What is the trend on the higher time frame? These questions matter far more than whether RSI is at 68 or 72. The third illusion, and perhaps the most dangerous one, is that RSI signals are equally valid in all market conditions. They are not. RSI works beautifully in certain types of markets and miserably in others. In a strong trending market, traditional overbought and oversold signals will destroy your account. In a ranging market, those same signals can be highly profitable. The skill of the master trader is not in knowing the indicator, it's in knowing when the indicator applies. So as we move into the 3 advanced strategies I'm about to share with you, I want you to release everything you thought you knew about RSI. Forget 70 and 30 as automatic triggers. Forget the textbook signals. Forget what every guru on the internet has told you. We're about to go deeper. We're about to look at RSI the way a professional speculator looks at it, as a window into the soul of the market, as a way to measure not just momentum, but conviction. Not just price change, but the psychology behind the price change. Because at the end of the day, the markets are made of people. And people are predictable in their unpredictability. The same patterns that played out in 1907, in 1929 inches, 1987 inches, 2008, in 2020, those same patterns are playing out today. The tools have changed. The names have changed. But human nature, my friend, human nature has not changed one bit. And that's why the 3 strategies I'm about to teach you have stood the test of time. They are not based on mathematical hocus pocus. They are based on human behavior, on the way fear and greed move through a market like a tide, on the way smart money accumulates and distributes while the public chases and panics. Are you ready? Then let's begin with the first strategy, and I promise you, this one alone, if applied with discipline, can transform your trading. The first advanced strategy I want to share with you today is RSI divergence, but not the way the textbooks teach it. I'm going to show you how to combine RSI divergence with structural confirmation to create one of the most powerful reversal signals in all of technical analysis. Let me start with the basics, briefly, for those who may be new. RSI divergence occurs when the price of an asset moves in one direction, but the RSI moves in the opposite direction. There are 2 main types, bullish divergence and bearish divergence. Bullish divergence happens when price makes a lower low, but RSI makes a higher low. This suggests that even though the price is falling, the momentum behind the decline is weakening. The bears are getting tired. The selling pressure is fading. A reversal may be approaching. Bearish divergence is the mirror image. Price makes a higher high, but RSI makes a lower high. The price keeps climbing, but the momentum is fading. The buying pressure is exhausting. The bulls are losing their grip. A reversal may be approaching. Now, here's where most traders go wrong. They see a divergence form on the chart, and they immediately enter a trade. Boom, they short the bearish divergence. Boom, they buy the bullish divergence. And 9 times out of 10, the market keeps moving in the original direction, takes them out at a loss, and then finally reverses without them. Why does this happen? Because divergence alone is not enough. Listen to me carefully. Divergence is a warning. It is not a signal. It tells you that the current trend is losing steam. But losing steam does not mean reversing. A car can coast for a long time after the engine stops. A market can grind higher long after the buying momentum has peaked. The professional speculator does not trade divergence in isolation. He waits for structural confirmation. And that is what I'm going to teach you right now. Here is the 4-step process for trading RSI divergence with structural confirmation. Step 1. Identify the divergence on a meaningful time frame. I'm not talking about a 5-minute chart, unless you're a scalper with iron discipline. I'm talking about the 4-hour, the daily, or the weekly chart. Divergences on higher timeframes carry far more weight than divergences on lower timeframes. They represent a broader shift in market sentiment. A bearish divergence on a daily chart is worth 100 bearish divergences on a 1-minute chart. Step 2. Wait for the swing structure to break. This is the part that almost no one teaches. After you spot the divergence, you must wait for the underlying market structure to break before entering. What does that mean? It means waiting for the price to break below the most recent swing low in the case of a bearish divergence, or above the most recent swing high in the case of a bullish divergence. This break of structure is your confirmation that the trend has actually reversed, not just paused. Step 3. Wait for the retest. After a structure breaks, the market often pulls back to retest the broken level. This is where the smart money enters. Not on the initial break, that's where the amateurs jump in and get whipsawed. The retest gives you a much better entry price, a tighter stop loss, and a higher probability of success. Step 4. Enter with a defined risk and a defined reward. Place your stop loss just beyond the most recent swing high or low. Target the next major structural level, a previous support or resistance zone, a Fibonacci extension, or a key moving average. Always know your reward-to-risk ratio before you enter. I will not take a trade with less than a 2-to-1 reward-to-risk ratio. 3-to-1 is better, 5-to-1 is glorious. Let me walk you through a real example so you can see this in action. Imagine a stock that has been in a strong uptrend for 6 months. It's been climbing higher and higher, making new highs almost every week. The RSI has been bouncing between 40 and 80, confirming the strength of the trend. Then one day, the stock makes a new high. Let's say it climbs from $100 to $120 over the course of 3 weeks. But when you look at the RSI, you notice something interesting. On the previous high, the RSI was at 85. On this new high, the RSI is only at 72. That's a bearish divergence. Does the professional trader immediately short the stock? No, he waits. He marks the most recent swing low. Let's say it was at $112. Then he watches and waits. Over the next 2 weeks, the stock pulls back to $115, then bounces to $118, then falls again, and this time it breaks below 112. The swing low is broken. The structure has shifted. Now the professional is interested. He waits for the retest. Sure enough, the stock rallies back up to test the $112 level, which now acts as resistance. The stock rejects this level. It can't get back above it. Now the professional enters short. His stop loss is at $115, just above the most recent swing high during the retest. His target is the next major support level, let's say $100. That's a 3-to-1 reward to risk trade. and the probability of success is much higher than if he had shorted at the first sign of divergence. That is how a professional uses RSI divergence, not as a magic signal, but as a piece of a larger puzzle. Now, I want to share with you something even more powerful. When you combine RSI divergence with what I call key levels, historical support and resistance zones, major round numbers, previous all-time highs or lows, the probability of success increases dramatically. Why? Because at these key levels, you have the maximum amount of market participation. You have buyers who bought at this level years ago and are now finally getting back to break even they sell. You have stop losses clustered above and below these levels, they get triggered. You have algorithmic traders programmed to react to these levels, they execute. The volume explodes, the volatility spikes. And if you have a divergence forming at a key level, with a structural break and a clean retest, you have one of the most asymmetric opportunities the market can offer. Let me give you one more piece of wisdom on this strategy. Patience is everything. You may go weeks without seeing a setup that meets all 4 criteria. That is not a problem. That is a feature. The fewer trades you take, the more selective you become, the higher your win rate will be. I would rather take 10 high-quality trades per year and make 30% than take 500 mediocre trades per year and lose 10%. The market will always be there. The opportunities will always come. Your job is not to catch every move. Your job is to catch the right moves, and to size them properly, and to manage them with discipline. This is exactly the kind of disciplined, patient mindset I write about extensively in my eBook, Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. If this strategy resonates with you, that book will deepen your understanding tenfold. The link is in the description below. Now let us move on to the second strategy, and this one, my friend, is where the real money is made. The second advanced strategy I want to teach you today is one that most retail traders have never even heard of. It's called the RSI 50-line trend continuation strategy. And once you understand this concept, you will never look at the RSI indicator the same way again. Most traders fixate on the 70 and 30 levels, overbought, oversold, buy, sell, as if the entire indicator can be reduced to 2 horizontal lines on a chart. But the real magic of the RSI, the part that the professionals use and the amateurs ignore, happens at the 50 level, the middle of the indicator, the dividing line between bullish momentum and bearish momentum. Let me explain why this level is so important. The RSI is essentially a measure of buying pressure versus selling pressure over a defined period. When RSI is above 50, it means buying pressure has been stronger than selling pressure. When RSI is below 50, it means selling pressure has been stronger than buying pressure. The 50 level is the equilibrium point, the boundary between bull territory and bear territory. Now, here is the secret. In a strong uptrend, RSI rarely drops below 50. It will fluctuate between 50 and 80, bouncing off the 50 line like a basketball off a hardwood floor. Every time it touches 50 and bounces, that is a high probability buying opportunity. The trend is intact. The momentum has cooled. The pullback is providing a fresh entry. In a strong downtrend, the opposite is true. RSI rarely climbs above 50. It fluctuates between 50 and 20. Every time it bounces off 50 to the downside, that is a high probability shorting opportunity. This is the foundation of the RSI 50-line trend continuation strategy. You're not trying to catch reversals. You're trying to ride trends, and the 50 line is your entry signal. Let me walk you through the precise steps. Step 1, identify the trend. Before you can trade trend continuations, you must first establish that a trend exists. There are many ways to do this. You can use moving averages, for example. If the price is above the 200-day moving average and the 50-day moving average is sloping upward, you have an uptrend. You can use higher highs and higher lows. If the price is consistently making higher highs and higher lows over your chosen time frame, you have an uptrend. You can use the slope of a trend line. You can use the directional movement index. Whatever method you use, be consistent and be rigorous. Step 2, confirm the trend with RSI behavior. This is where it gets interesting. Once you've identified the trend, look back at how the RSI has been behaving. In a strong uptrend, you should see the RSI consistently making higher lows on the indicator itself, and those lows should be bouncing off or above the 50 line. If the RSI has been respecting 50 as support during the uptrend, you have a confirmed RSI trend. Step 3. Wait for the pullback. Markets do not move in straight lines. Every trend has its corrections. Every advance has its retreats. Your job is to wait patiently for the pullback. As the price corrects, the RSI will drop from its higher reading, perhaps from 75 down toward 50. Do not anticipate. Do not enter early. Let the pullback play out. Step 4. Enter on the bounce from 50. When the RSI approaches the 50 line and then turns back up, that is your entry signal. You're entering on a pullback in a confirmed uptrend, with momentum about to resume. This is the highest probability entry in trend trading. Step 5. Manage the trade with structural stops and trailing exits. Place your initial stop loss below the most recent swing low in price. As the trade moves in your favor, trail your stop using either a moving average, the most recent swing low, or a percentage-based trailing stop. Let the trend run. Do not cut your winners short. Most traders fail not because they don't catch good trades, but because they exit good trades too early. Now I want to share with you a sophisticated variation of this strategy that the professionals use. It's called the RSI 50 line failure swing. Here's how it works. In a strong uptrend, RSI bounces off 50 consistently. But every now and then, the RSI will dip slightly below 50, maybe to 45 or 48 before bouncing back above. This temporary failure to hold 50 is actually one of the most powerful continuation signals in the entire indicator. Why? Because it shakes out the weak hands. The traders who are watching the 50 line as support get nervous when it breaks. They sell, they panic. And then the price reverses and rips higher, leaving them stranded on the sidelines while the smart money loads up. When you see the RSI dip below 50 in a strong uptrend and then quickly recover, that is not a sign of weakness. That is a sign of strength. The market is testing its own resolve and passing the test. The professional uses this dip as an opportunity to add to his position at a discount. Of course, you must combine this with price action. If the RSI dips below 50 and the price also breaks a major support level with high volume, that's a different story that may be the beginning of a true trend reversal. Always look at the indicator in the context of the price. Always. Let me give you another example. Imagine a currency pair that's been in a clear uptrend for 2 months. It's making higher highs and higher lows. The 50-day moving average is sloping upward. Price is well above the 200-day moving average. The RSI has been ranging between 50 and 75, bouncing off 53 times in the past 2 months. Each time it bounced, the price rallied to a new high. This is a textbook RSI 50-line trend. Now you see the price beginning to correct. It's coming down from a recent high. The RSI is dropping 65, 60, 55, 50. You watch and wait. The RSI touches 50 and turns up. You check the price action. There's a bullish candlestick forming at a key support level. You enter long. Your stop loss is below the recent swing low. Your target is the next resistance level above, or you simply trail your stop and let the trend run. This is methodical. This is patient. This is professional. The beauty of the RSI 50-line strategy is that it keeps you on the right side of the trend. It prevents you from picking tops in uptrends and bottoms in downtrends, which is what destroys most retail traders. It aligns you with the dominant flow of capital, and it gives you clear, objective entry and exit criteria. Now, I want to give you one final pearl of wisdom on this strategy. The RSI 50 line works on every time frame. It works on the 5-minute chart for day traders. It works on the daily chart for swing traders. It works on the weekly chart for position traders. The principles are identical. Only the time frame changes. So whatever your style of trading, you can adapt this strategy to your needs. But, and this is critical, you must maintain consistency in your time frame. Don't switch between the daily chart and the 4-hour chart based on which one is giving you the signal you want. That's called chart shopping, and it's the death of consistent trading. Pick your time frame, master it, stick to it. This level of discipline, choosing one time frame, mastering one strategy, sticking with it through thick and thin, that is the kind of psychological work I cover in detail in the Livermore Journal, a 90-day trading psychology workbook. If you're serious about building discipline, that journal will be your daily companion. The link is in the description below. All right, 2 strategies down, 1 to go. And I've saved the most powerful one for last. The third and final strategy I want to share with you today is the most advanced of the 3. It is the multi-timeframe RSI Confluence system. This is the strategy that separates the amateurs from the professionals. This is what allows you to enter trades with a level of confidence that most traders will never experience in their entire careers. Here is the core idea. Most traders look at one time frame. They pick the daily chart, or the 4-hour chart, or the 1-hour chart, and they make all their decisions based on that single view. But the market is fractal. It exists on multiple time frames simultaneously. The daily trend is built out of the 4-hour trends. The 4-hour trends are built out of the 1-hour trends. And so on, down to the tick. The professional trader understands that a trade has a much higher probability of success when multiple time frames are aligned. When the weekly RSI, the daily RSI, and the 4-hour RSI are all telling the same story, you have what I call confluence. And confluence is the holy grail of consistent profitability. Let me show you how to construct this system. Step 1, choose 3 time frames. You need 3 time frames that are related but distinct. A common combination is the weekly, the daily, and the 4-hour. Another is the daily, the 4-hour, and the 1-hour. Another is the 4-hour, the 1-hour, and the 15-minute. The principle is the same. You have a higher time frame to establish the dominant trend, a middle time frame to identify the setup, and a lower time frame to time the entry. Step 2, define the trend on the highest time frame using RSI. This is your anchor. If the weekly RSI is above 50 and trending upward, your bias is bullish. You will only take long trades on the lower time frames. If the weekly RSI is below 50 and trending downward, your bias is bearish. You will only take short trades on the lower time frames. This single rule will eliminate 80% of the bad trades you would otherwise take. It forces you to align with the dominant force in the market. Step 3, identify the setup on the middle time frame. Once you know your bias from the highest time frame, you go to the middle time frame and look for a setup. This could be a divergence, a bounce off the 50 line, an oversold or overbought reading at a key level, whatever your preferred setup is. The setup must be aligned with the bias from the highest time frame. If your weekly bias is bullish, you're looking for bullish setups on the daily bullish divergences, 50-line bounces, oversold conditions at support. Step 4, time the entry on the lowest time frame. This is where the precision comes in. Once you have your bias from the highest time frame and your setup from the middle time frame, you drop down to the lowest time frame to find the precise entry. You're looking for a confirmation candle, a momentum shift, an RSI cross above or below 50 on the lower time frame. This precise timing allows you to enter with a much tighter stop loss, which dramatically improves your reward to risk ratio. Let me give you a concrete example. You're trading a stock. You look at the weekly chart first. The RSI is at 58 and has been trending upward for 3 months. Bullish bias confirmed. You move to the daily chart. You see the price has been pulling back over the past 2 weeks. The daily RSI has come down from 75 to 52 and is now bouncing right off the 50 line. There's a clear bullish setup forming. The RSI is turning up from 50. The price is sitting on a major support level, and there's a bullish engulfing candle forming on the daily. Now you move to the 4-hour chart. You're looking for the precise entry. You watch as the 4-hour RSI dips into oversold territory at 28 and then begins to climb back. As soon as the 4-hour RSI crosses back above 40, with bullish price action confirming, you enter long. Your stop loss is below the most recent 4-hour swing low, a very tight stop. Your target is the previous daily high, or even higher if the weekly trend continues. Do you see the elegance of this? 3 time frames, 3 confirmations, 1 precise entry, tight risk, massive potential reward. This is the kind of trade that professional speculators take. They wait, they observe, They demand multiple confirmations before they commit capital. And when they finally do enter, they do so with conviction because everything is aligned. Now I want to give you a few additional principles that will make this multi-time frame system even more powerful. First, never trade against the highest time frame, ever. If the weekly RSI is below 50, do not take long trades, no matter how tempting the daily setup looks. Counter-trend trading is a graveyard for retail traders. The professionals trade with the trend, so should you. Second, when the lower time frames diverge from the higher time frames, sit on your hands. If your weekly bias is bullish but your daily RSI is breaking down below 50, that's a warning. Wait for clarity. The market is in transition. Do not force a trade. Third, use position sizing to manage your risk. Even with the best multi-time frame setup, you must never risk more than 1 to 2% of your account on any single trade. Why? Because no setup is 100%. Even the highest probability trade can fail, and if you're sizing too large, one bad trade can wipe out months of careful profits. Risk management is not optional. It is the bedrock of consistent profitability. Fourth, keep a journal. Every trade you take, every setup you observe, every emotion you feel, write it down. Review it weekly. Review it monthly. Pattern recognition is built through deliberate practice and reflection. The journal is your laboratory. It is where you become a master of your craft. This is precisely why I created the Livermore Journal, a 90-day trading psychology workbook to give you a structured framework for this essential practice. Link in the description. My friend, we have covered a tremendous amount of ground today. 3 advanced RSI strategies: Divergence with structural confirmation, the 50-line trend continuation, and the multi-time frame Confluence system. Each one of these strategies, applied with discipline and patience, can transform your trading. But let me leave you with one final thought. The strategies I have shared with you today are not magic. They are not guarantees. They are tools. And like all tools, they only work in the hands of a skilled craftsman. The skill is built over years, through study, through practice, through making mistakes and learning from them, through losing money and discovering why, through winning money and remaining humble. The greatest enemy of every trader is not the market. It is himself. It is his impatience, his greed, his fear, his ego. The market will reward those who master themselves, and it will punish those who do not. There are no exceptions to this law. If you take nothing else from today's lesson, take this: your strategies will only ever be as good as your discipline. Your indicators will only ever be as accurate as your psychology. Your account will only ever grow as much as your character allows. This is why I have written Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk, because the inner game is the real game. And it's why I created the Livermore Journal, a 90-day trading psychology workbook, to give you a daily practice that builds the mindset of a master speculator over 90 transformative days. Both eBooks are linked in the description below. Take them, study them, live them. Now, before you go, if you found value in today's video, do me one small favor: smash that like button. It costs you nothing, and it tells the algorithm to share this wisdom with more traders who need it. Then hit that subscribe button and ring the bell, because we release new videos every week here at the Jesse Livermore Trading Code. Videos on market psychology, technical analysis, money management, and the timeless principles that have separated winners from losers for over a century. Coming up next, I'll be revealing the 7 trading rules that I followed religiously throughout my entire career. Rules that, when broken, cost me fortunes, and when followed, made them. You will not want to miss it. Until then, my friend, trade with discipline, trade with patience. And remember, the market does not care about your hopes, your dreams, or your bills to pay. It only respects those who respect it. The trading code is yours to crack. I'll see you in the next video.